What's going on, everybody? Welcome back to That Makes Zero Sense. My name is Alex Savanovich. I'm your host, and we're going to dive right into today's episode. We're going to go back to the model that we were running the last few weeks before last week. I got a lot of questions from people who listen to the show. I chose the five most interesting questions, at least interesting by my standard, things that I thought were interesting, or at least interesting to talk about on the podcast. So I've got my notes. I'll go through the questions, but quickly before we do that, just want to say it was a busy week in the markets this week. There was a ton of geopolitical stuff going on. There was a bunch going on from the Trump administration. There was so many earnings reports. I think people think that the first week of earnings, when all those mega caps and large cap names in general report, is the busiest week, which is true. That is, the majority of S&P 500 companies are reporting. It's super busy. All of the companies that everyone seems to focus on are reporting. But these weeks that follow that, you start to have some of these smaller to mid cap names reporting, and there's so many of them outside of the S&P 500 and there's still names in the S&P 500 that need to report. Look at NVDA today, CRM today. Some big companies are still reporting, so there's still so much going on, so much to digest. Some days it's tough to keep up, but we're doing our best. So without further ado, let's hop right into the show, and I'm going to answer some of the questions that you guys have for me. So question number one says, what were your biggest takeaways from reports you saw this week? Okay, well, like I just said, there was a ton of reports. Where do I start? Geez. Uh, I read not an analyst note, but a little investor piece from, I think it's Rosberg, if I'm getting the name correct. Um, they were talking about Home Depot and Lowe's. They had some interesting commentary around the strength of the American consumer, especially middle to lower income consumers, maybe holding off on home improvements because they're not so certain on the future for themselves or job security, whatever it might be. They're not spending as much on home upgrades or home DIY projects, et cetera, et cetera. I thought that stood out a little bit and was interesting. It was an interesting read through, I think, to the American consumer. What else? NVIDIA today. Well, I think eventually touch on that in one of the later questions. I highlighted a question where I'll go into more depth on that. But NVIDIA reported, I think, as far as flawless quarters go on paper, it was pretty spotless. And to see the price action, it sell off in the morning. First of all, it wasn't really up in the pre-open at all. It was maybe a couple percent. I know initially when the report dropped, it did this spike and then came back in and then sort of meandered it unchanged up 1 to 2%. And then on the open today, at the time of this recording, it's Thursday. So on the open today, Nvidia fell out of bed. All of the semis sort of fell out of bed. And then Nvidia struggled to catch a bid and traded at lows basically the entire day. Now, after such a great quarter, that definitely raises some eyebrows. So we'll touch on that a little bit more later, I think. And then some of these software reports, I mean, not all of them have been great. There has been some concern in some of the software reports, but the bar was so low going into these major software reports that I think even if their revenue and earning per share numbers are just where analysts were sort of penciling in the figures, they seem to either gap down on the report or gap up and then trade well. If they gap down, then they trade well in the intraday. I think a lot of bad news was priced in given sort of some of the AI, SaaS apocalypse, whatever people want to call it. The bar was set super low. So there's not a lot of software stocks that are opening awful and then trading lower. I think Zoom was one of the exceptions. So all in all, I think the reports have been fine. I just think this market is a little bit shaky. And, that's sort of illustrated in the syndicate market. There's not a whole lot of new issues. There's a bunch of secondaries happening, but just the tenor in general and where you see flows, where you see money moving. I just don't think I guess infrastructure is not really the right word, but like the market infrastructure, the demand for stock is not really there right now. And so you'll have sometimes like a great report. Look at some of the Mag 7 names. They had some blowout numbers, great reports, and then they would trade down because the free cash flow numbers are starting to become a concern. CapEx is only growing. And so, this market is starting to become very, very bifurcated, more and more so each day, I would say. And that's being accelerated by some of these new data points that we're getting from the earnings reports. So that's question number one. Let's move on to question number two. What are your thoughts on AI model makers? Which are under or overvalued in your opinion? Which are the best in your life for trading? So I'll answer the trading one because that's the easiest one to answer right off the bat. None of them are really great for trading. I mean, it depends what you use them for. I've experimented with them. I've talked about on the show before where I build my own models for trading. I collect a bunch of data. I've been collecting data for 7 years now. So, yeah, six or 7 years now. And I've built models to influence my trading and help me make decisions when I'm trading. I sort of have an idea in my head of what a high percentage trade is versus a low percentage trade. And so I stay out of the low percentage ones because of these variables I've looked at for years and years and years now, thousands and thousands of data points in, I guess, my sample. I think they're great when you're crunching the numbers and you're building a model. They're obviously really good at working in Excel. The one that I recently have really enjoyed using is Claude. Opus 4.6 is really great. I enjoy Gemini. Gemini's, I think, very, very intelligent and very good for day to day questions. I haven't really used Gemini a whole lot as it relates to using it inside of Google's suite of apps like Google Sheets, Gmail, etc. So I haven't really explored Gemini in too much depth. I personally think, and this might be a hot take, I don't think ChatGPT's product is keeping up. I haven't messed around with Codex at all, but some of my friends who are software engineers say that Codex is on par, if not better, than the coding product that Claude has put out. That Anthropic has put out through Claude. So to answer the question. I think all the models can sort of now it's to work on an Excel sheet and to work through, I guess, trading ideas and collect data. It's fine for that sort of stuff. I haven't per se used it to actually algorithmic trade. I'm not going to sit here and say I'm intelligent enough to employ a strategy like that. I'm sure if I sat with it long enough, I could figure it out. But I have a system, it works, it's profitable, and I'm sticking with my system. And AI definitely helps to some extent. Now, as far as valuations go, it's tough to say what the valuation on a model like Gemini is because Gemini is obviously a Google product, and Google's valuation is based on not just Gemini, but a multitude of things. You have search, you have YouTube, you have ad revenue. There's so many different things that go into um, valuing Google that it's tough to single out Gemini. I do know that the Gemini growth is accelerating and is very good and might even be taking share from OpenAI. If you know me, you know that I definitely think the latest funding round for OpenAI, where they're trying to raise money at an 800 or $850 billion valuation, in my opinion, is very aggressive for a company who earns as much as they do, or as little as they do, in my opinion. Anthropic, I don't think is a whole lot better, but is more, I think, of a fair valuation. I don't think it's cheap, but I think it's fair. Perplexity, same sort of thing as Claude. It's tough to say. I mean, do I think that AI and some of these models is going to be, revolutionary? For sure. I think it's going to help people do their jobs more efficiently. I think it'll help software engineers be more efficient. I think there's so many things that AI will help us with. I just don't know that these companies raising money at these astronomical valuations, that this trend is going to continue. I don't believe that if OpenAI raises money at an $800 billion valuation, for example, that the next round is going to be at a trillion or a trillion and a half. I don't think that that's the case, especially when it seems to me that these models, or I guess for lack of better terms, tokens are being commoditized. This sort of feels to me like an email provider, for example. You go with Outlook, you can go with Gmail. They're all very similar. They all offer like very similar things, maybe a feature here or a feature there that makes you want to go with one versus the other, priced very similarly. It's a very competitive market. And I think for OpenAI to think they can raise money at a valuation of $800 billion or 850, I can't remember what the number is exactly, is sort of ridiculous. And we've talked about it so many times on this show. So I'm not going to speak too much more on valuation, but That's my opinion. I do think the space is overvalued. And as far as models go, I've told you which ones I like the best, and I don't really have a whole lot to say on them. So let's move on to question number three. Any new syndicate color from the last 2 weeks? Last week was a shortened week, but this week was quiet also, question mark. Yeah, last week was definitely quiet, and I think, well, first of all, it's a shortened week, and typically on shortened weeks in the market, you don't see a whole lot of syndicate activity ever. Maybe a couple deals priced, maybe a couple SPACs, but it's never super busy on a shorter week. That's just the way that it goes. This week was a full week, however, and we didn't see a whole lot of deal flow. There were a bunch of SPACs. Most of them opened unchanged or broken, which is interesting to me. Even, there was a deal from Alliance Global Partners this week that had a quarter of a right. And typically you see a deal with a quarter of a right. Um, sorry, a right worth a quarter of a share. You see something like that. It should open unchanged at the very least. In my opinion, it should open at 10:01 or 10:02. Sometimes it, depends on the underwriter. And I think in this case, it might have the underwriter might have played a part in the reason why it opened broken. However, a right worth a quarter of a share is worth something. And I was shocked to see it open broken and a couple other SPACs open broken. The only deal on the week this week, I'm forgetting the name of the company, but the ticker is GENB. I think Goldman and Morgan Stanley are the lead underwriters. Um, that was supposed to be a hot deal this week. Earlier in the week, I was hearing that it might price near the high end of the range or even above the range. And that fizzled out. I think they're pricing the deal tonight to trade tomorrow unless they pull it. I don't know where it's priced yet at this time. I haven't looked. But the fact that some of the people I speak to have downgraded it and are not super hyped up, it went from being 10 times oversubscribed to only 2 to 3 times oversubscribed. It's clear to me that the syndicate market, sorry, is very fragile right now. And I think that's just a sign of the times. And like we said, the market struggles right now to make a new high. We've been meandering all of 2006 so far. And so those are my comments on the syndicate market. Question number four. You talk a lot of negative on AI. Are there any other groups of stocks you don't like or might short sell? Again, I'm not going to recommend a short sell. Shorting stocks is a dangerous game. Be a professional. If you're going to do it, know what you're doing. And I'm not giving any investment advice ever on this podcast. Is there a group I would be inclined to short sell? I do think the memory trade in SanDisk and Micron, Samsung is sort of extended. I was reading a note today about how the Korean stock market is at all-time highs and accelerating so far in 2026, mainly because of this phenomenon in memory, where memory has become so expensive. You had HPQ, Dell, some of these hardware providers talk about how expensive memory is becoming, and it's starting to eat into their margins. So it's no surprise to anyone. We've been talking about it forever. I think I've mentioned it on this podcast before that memory is not just becoming, memory is very expensive and might become more expensive. Now, what does that mean for the stocks? The stocks have obviously seen a massive run up with this news about memory becoming so expensive and the demand for HBM, for AI products. I think that trade is due for reversal, especially if, and I'm going to comment on this later, especially if you start to see money come out of semis in general, as you saw today with NVIDIA, AMD, Intel. If the SMH and the SOXX, which are the two bigger semiconductor ETFs that hold a lot of these companies, if money starts to flow out of those ETFs, I think money by proxy will start to flow out of memory related semiconductor names. And if that money starts to go into software or other unloved parts of the market, I sort of at this time like the short sell idea in memory stocks, specifically SanDisk, Micron, and probably a few others that I can't name right now. And there's probably other groups as well, but do your research. I just, for the purpose of this podcast, that's the first one that comes to mind that's super interesting to me. I also think staples have had a huge run, and the XLU, which are the utilities, have had a huge run as well. They were a huge beneficiary of people getting sort of afraid of software and maybe cold feet on AI and the capex numbers and the free cash flow in the Mag 7. As people have pulled money from those groups, they've went and bought the staples and the XLU, because those are more defensive names if the consumer is truly getting weak. Um, I'm not sure if those trades still have a lot of legs. They've had massive runs in 2026 so far, and they might be due for a reversal as well. Those are other shorts I'm sort of interested in, but I'm less hyped up to be short staples if we truly enter a recession. That's a group that I think will see a lot of money flow in. So next question number 5. If you had to give one piece of advice to yourself on the first day you started trading, what would it be? I think anyone with a brain can pick up the mechanics of trading, the entering a buy, the entering a sell, entering a short, entering a stop out, understanding levels, like that sort of mechanical stuff. You don't need a degree, you don't need to be a university graduate to understand how to enter orders and do all that stuff. That will come with, honestly, a few weeks of practice. Like, you just hop in the desk, trade every day for a few weeks, and you'll understand the mechanics of clicking the buttons and doing that mechanical side. If I had to give someone advice or give myself advice on the first day trading, and this was something that took me, I want to say, the first year to really grasp before I started to really focus on it, maybe even 2 years, honestly, now that I think about it. I wish I'd known on the very, very first day to attack my mental and emotional model from the get go, because it took me a lot of time to understand that that was such a big piece of trading. Trading's a mental game. If your emotions are running amok and they're not in check, and you're doing silly things and you're acting irrationally, or you're acting emotionally or on emotions, and you're making decisions based on a feeling, that's something you need to figure out on day one. And I'm not saying that you need to figure it out figure it out on day one and don't start trading until you figure it out. You have to put risk on to feel those emotions, to feel those feelings, and understand the things that you go through. All of us have walked different walks of life. We've all had different unique experiences, and things that we've experienced early on in life are going to impact when we see a stock rip. And we don't sell it and it comes back in, and then we sell it at the low and we take a loser or break even trade, and we're sitting there wondering, why did I sit there while it ripped on me? Or you see a stock go against you and it's falling out of bed, and you're thinking, oh, it's going to come back, it's going to come back. These are all things, these are mental mistakes. You need to have a stop, you need to know when you're going to take profits off the table. Are you going to hold a piece and wait for maybe a 3, 4, 5x move? These are all things that come with time. But if to answer the question, if I could give myself a piece of advice on the first day of trading, it would be to really focus on the emotional side of things, and to really monitor that and be aware and cognizant of the things that you're feeling. I think a trading journal is great. And to write about what you did when you were trading is awesome. But you also need to have, at the end of that journal, what you were feeling in each trade, so you can reflect on, oh, why was I feeling scared here? Why was I feeling anxious here? Why was I feeling super euphoric when this trade went on? It's important to understand those emotions to really bring your trading to the next level. And I think that's something I didn't focus on for a long time, until it sort of clicked for me that, I need to, master this side of myself in order to be a better trader. And so that's the piece of advice I would give myself on day one. So maybe I wouldn't spend the first 2 years meandering along, being break even, or even red for the first 2 years. Maybe I would start winning a lot earlier. Okay, there's a question number 6 here. I know I said only 5 questions, but this was sort of a fun one. This isn't market related, but I know you are Canadian born. Are there any comments on the men's hockey gold medal game? Obviously, it breaks my heart to see Canada lose. I think I'm only 25 years old, so I've only seen a handful of Olympic hockey games, and I've only seen a handful of Canadian teams play. This might have been one of the best Canadian hockey men's hockey teams I've ever seen. It was such a stacked roster. Um, Watching the game, we had constant pressure on the Americans. It was a phenomenal game to see some of our best players play at the highest level. I think some of our players, you know, might have choked a little bit. Anywho, do I wish we got the dub? For sure. But I think it's an awesome win for the Americans. Congratulations to them. That's all I've got to say on the game. I don't watch a ton of hockey on my personal time, but it was a fun game to watch. And also, Connor McDavid's got to figure it out, man. So that's all I've got to say there. That's all I've got for the podcast. I hope you guys have a phenomenal Friday and a great weekend. Take care, and I'll catch you on the next episode. See you later. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.